So I'm here today with Jeff Levine. The QBI deduction, the qualified business income deduction, financial advisors in general are considered to be
a bad class of business.
A bad class of business.
Yeah. What's known under the law as a specified service, trade, or business. And what that means is that as their income exceeds certain levels, their QBI deduction goes from being 20% of either the lesser of their taxable income or their business profits to being zero very quickly.
And what are those levels?
So for married couples filing a joint return, it's about $315,000. For single filers, it's half of that. So $157,500 in that range. It has a cost of living adjustment for each year, so we'll see those values go up in the future. But for a lot of advisors, that's enough to cover them, right? I mean, look, $300,000 of income for a joint couple covers a lot of people. But there are also a lot of very successful financial advisors out there who have incomes well in excess of that, and many of them will see their QBI deduction very quickly go from $50,000, $60,000 at $315,000 to zero.
And so that creates essentially a very high marginal tax rate over the course of maybe $100,000 of income.
It definitely does. And what's really interesting about the law is that depending upon what type of financial advice you might actually do, and I use kind of the word advice there because the law really makes a distinction between investment advisors and insurance salespeople.
So what's special about insurance salespeople?
So whereas the financial advisor who is doing investment advice, and in fact, even the regulations list certain titles, so like wealth manager, et cetera. These individuals, once they have income that exceeds those thresholds, very quickly phases out, their deduction goes to zero. On the other hand, business owners who are non-specified service business owners are potentially able to, what I like to call, save their deduction. And they can either save it by having wages paid out of their business, or and to themselves too, by the way, or they could have some combination of wages and property owned by the business. And interestingly enough, insurance sales, insurance brokerage doesn't fall into the specified service business. It's considered a non-specified service business. So a very high income insurance producer who maybe has a staff and pays them wages out of their insurance practice can actually preserve some of their QBI deduction, if not all of it.
So what about an insurance agent who is also a wealth manager? How do they deal with that?
Sure, a lot of advisors today have some sort of hybrid role, and unfortunately, you're only going to get that for the insurance side of the business. Now, in the final regulations, there was a really subtle change from something that was in the proposed regulations. The proposed regulations said that in order to get the QBI deduction, you had to have separate records. The final regulations amend that, and they say that your records need to be separable. So you need to be able to essentially account for what your profits of the insurance business are, what your revenues are, what your expenses are, so that you can figure out the profit that is specific for that line of business. And then, based on that, you should be able to get the deduction for only the insurance part of your business. And everybody says, well, how could this possibly be? Why do insurance people get all these benefits and we get nothing if we're just investment advisors? And it's very simple. The way they wrote the law, the IRS, Section 199A, which is what the QBI deduction is organized under, references a subsection of the code. And the subsection of the code, it lists things like, advisors and consultants and lawyers and healthcare professionals, et cetera. There's another subsection right below the one they referenced, which is not referenced in the actual text of the Tax Cut and Jobs Act, where this 199A deduction comes from. And that second subsection that's not referenced actually includes insurance sales, insurance brokerage, real estate brokerage. And so those individuals, real estate brokers too, are not considered specified service business owners under this law. So what it does is it gives them a chance. There's always, so you're saying there's a chance. So it's the same thing here. There's a chance for those individuals to preserve their QBI deduction, but it still takes wages or depreciable property once you get above those income limits.
So the bottom line is that the rules now are favorable for those who are selling insurance products or brokers of any products in general, but
insurance products. If it's a securities brokerage, would be the same as if you're giving investment advice. So specifically for insurance.
Excellent. Okay. Well, thank you very much, Jeff.
Thank you.